The economy continues to send us mixed messages about where we are headed in 2023. Last week's jobs report was a bit of a stunner, as more than 500,000 jobs were added to non-farm payrolls in January. The unemployment rate fell to 3.4%, the lowest since 1969. It is hard to consider that the economy is in recession with numbers like that. But a consensus remains with most economists that we will enter one this year. In fact, some already believe we have. This week on the fastest 4 minutes in finance, though, we won't debate will we or won't we, but instead look at how long it could be if we do. For those of you watching the video version of the fastest 4, take a look at this chart from LPL Research. It shows us the lengths of every recession since 1920. The measurements are taken from the peak month or peak quarter of economic activity to the trough month or quarter of activity. You can see that recessions vary greatly in length. The longest recession in U.S. history lasted 43 months. Of course, that was more than a recession. It was the Great Depression. Since World War II, the longest recession lasted 18 months, caused by the financial crisis of 2008. The shortest recession on record was the last one in 2020, caused by the government-forced economic shutdown over the COVID-19 pandemic. So the average length there you see of a recession since World War II is about 18 months. Whether the next recession is shorter, longer, or right about average depends on what causes it. As we already mentioned, the longest recessions were brought on by massive fundamental flaws in the economy. LPL chief economist Jeffrey Roach believes a 2023 recession would not be caused by economic problems of that magnitude. In fact, he says, quote, "A potential recession this year would likely be shorter than average because consumers appear to be on better footing with access to a hot labor market and still holding on to a large amount of cash. Unemployment rates are at historic lows, job openings are still very high, and checkable deposits and money market accounts are flush with cash." So if he's right, there's a huge takeaway for investors. First, historically, the stock market falls before a recession officially starts and begins to recover before the recession ends. So if there is a 2023 recession and the market has already taken a hit, there's reason to believe better times are ahead sooner rather than later for stocks. And take a final look at the chart. Look at the two far-right columns. Since 1920, the U.S. economy expands on average almost twice as long as it contracts. The average recession, 18.2 months. The average expansion lasts 35 months. More reason to be optimistic for stocks over a long time horizon, and a reminder that it's not about timing the market, but time in the market. Thanks for listening.